I'm Anil Keswani and I teach at Cass Business School in London, and I'd like to tell you about some recent research I've been doing on the flow-performance relationship around the world. The key finding from US research on the flow-performance relationship in mutual funds is that there is convexity in the flow-performance relationship. And by that we mean that investors chase funds that have done relatively well very strongly, but fail to sell losers with an equal intensity. So the main implication of convexity in the flow-performance relationship, or why it's important, is that it encourages risk-taking by mutual fund managers. Fund managers have an incentive to gamble to get up the performance scale, because if they do so, they know that they stand to get the lion's share of fund flows. However, fund managers know that if they gamble and do poorly, that they will not be punished for doing so. Behavioral biases have been argued as one explanation for why there is convexity. It is argued that investors overweight recent fund performance when fund performance has been favorable, but underweight fund performance when recent fund performance has been poor. Another explanation proposed is due to marketing. It's been argued that fund families, fund management companies, will advertise funds that have done recently well, but will obviously not advertise funds that have done recently poorly. As a result, this asymmetry in marketing effort may explain why we observe convexity in the flow-performance relationship. A third explanation that's been proposed for why we observe convexity is participation costs. It's been argued that the costs of participating in mutual funds, either in the form of information costs or direct costs in the form of fees, may explain convexity, and that funds with lower participation costs will have lower convexity in their flow-performance relationship. The idea in our paper is to study the flow-performance relationship around the world and to try and explain its shape. The main idea in this paper is to argue that we would expect development levels to explain convexity. Why might we expect this to be the case? We argue that investors from more developed countries, where the mutual fund industry is more developed and financial markets are more developed, will be more sophisticated. And as a result, they will be less prey to behavioral biases and less swayed by recent advertising. So for these reasons, we would expect investors from more developed countries to display less convexity in their flow-performance relationship. So this is what we try and examine using an around-the-world panel of mutual funds. We have funds from 28 countries around the world. We have a panel of about 17,000 funds, and we try to examine whether this is the case. And the punchline, or our key finding in this paper, is that development levels, whether proxied by economic levels of development, financial market levels of development, or mutual fund industry levels of development, all help us to explain the levels of convexity we observe around the world in the flow-performance relationship for mutual funds. We then go on in our paper to examine whether this convexity explains the risk-taking we observe by mutual fund managers across different mutual fund industries. We find strong evidence that the levels of convexity in the flow-performance relationship do have an economically significant and important role in explaining the amount of fund manager risk-taking we observe.